Good afternoon. I'm Jim Lang, and I'm here with Burton Malkiel. And I wanted to start by congratulating Burt on his 50th anniversary edition of A Random Walk Down Wall Street. There's already 2 million books of former editions in print, and who knows how many books he's going to be selling this time. This book is in practically every list of the most important financial books in history. Personally, I think the introduction alone is worth many thousands of dollars to any investor who would read it and put it into practice. And Burt, let me start with a question, because in the introduction to the book, you quoted something that you wrote 50 years ago. And what you said was, a blindfolded chimpanzee throwing darts at a list of stock prices could select a portfolio that would do as well as the portfolio selected by experts. Now, at the time, you were demonized. There was all types of negative press. And even you yourself joked that you and Jack Bogle were the only shareholders of what was then known as Bogle's Folly, which of course now is known as the Vanguard S&P 500. Do you still think a blindfolded chimp would do as well as the experts?
Actually, Jim, I believe in that even more strongly than I did 50 years ago when I first wrote the book. And before index funds were even invented. I absolutely believe it now. And there are 50 years of evidence to prove that it's absolutely true.
One of the things that you do throughout your entire book is that you document and provide evidence for virtually every assertion that you make. What kind of evidence can you maybe quote or refer to that actually proves that the blind chimp could do as well or better than the portfolio experts?
Well, there are several empirical academic studies, but there are also studies that are available for all investors to look at by just going into the internet. The Standard & Poor's Corporation does a study every year, and it's called their SPIVA study. SPIVA, the idea is it's S-P-I-V-A, and it is the Standard & Poor indexes versus active managers, versus those people on Wall Street who are picking securities and putting together, quote, professionally managed portfolios. So SPIVA does these every year. And in every new edition of the book, I quote the SPIVA results, and they are amazingly consistent. That is to say that in every single year, you find that 2/3 of the stock pickers do worse than a broad-based index of all stocks, which is exactly what's in an index fund. So every year, 2/3 of the brilliant stock pickers are outperformed by the index. And the problem is that the 1/3 who do better in one year are not the same ones as the 1/3 who do better in the next year. So that when you compound the results over 10 or 15 years, you find that now 90% of the active managers are outperformed by the index. Now, I'm not saying that it's impossible. I'm not saying it's impossible. You will find there are a few managers who have done it. There are people like Warren Buffett. But to try to find those for an ordinary investor, you're much more likely to be in the 90% part of the distribution where you do worse than the index. And interestingly enough, even Warren Buffett, who must be, I think most people would say, is our most successful investor, even Warren Buffett has not outperformed the index over the last decade. And he has recommended in his will that his assets all be invested in a simple, broad-based index fund. So the evidence is very clear. And in fact, if listeners want to prove it for themselves, go into the internet, look up the Standard & Poor's so-called SPIVA, S-P-I-V-A studies, and you will find exactly what I am telling you.
Well, so let's assume that the broad-based index does outperform. Are you taking into consideration maybe fees that a portfolio manager would have or any additional trading costs?
Absolutely. And I think that is one of the reasons why the index fund has such a wonderful record. There is a table in the 50th anniversary edition to actually demonstrate how different the results are because of fees, because of expenses, because of trading costs. And you find that the active manager not only underperforms, but underperforms by approximately 1 percentage point a year. And that's terribly important because these fees compound just as returns compound. And Albert Einstein once said that compound interest is maybe the greatest force in the universe. And compound interest is what makes a 10% return for something invested in 2 years. Not if you don't invest $1 for 2 years at 10%, you don't have $1.20, you have $1.21 because the 10 interest from the first year makes money. Your interest makes money as well as your principal. So you have $1.10 after 1 year and $1.21 after 2 years. That's the miracle of compound interest. Well, the costs compound too. And the difference in terms of dollars is simply remarkable. There's another chart in my book. This isn't readily available for everyone. It was done for me by the Vanguard group. And it took the following calculation. It said, what if you're a person of very modest means? You don't have much money at all. Your thought of becoming a millionaire is just as far away from you as you could possibly imagine. So I'm saying, what if you invested $20 a week? There's a couple of trips to Starbucks for your breakfast and your latte. What if you invested that in an index fund starting in 1978, which is when the first index fund was actually in existence. The index fund was not in existence when I first wrote the book. So what if you did that? $100 a month put into an index fund and consistently left in the market, left to grow at the returns of the stock market. What do you think you've got today? You've got almost $1.5 million. So that anybody, any ordinary person can do this, and you can become a millionaire. And if you're lucky enough to work for a company who will match your $100 a month, You could have $3 million from doing this. So it is possible, and you can do it with index funds. And there is simply no question in my mind. It's very unusual when, in fact, the best investment advice you can get is also the simplest. You know, people in Wall Street will tell you it's too complicated. You can't do it. You need professional help. You don't need professional help. It's very, very simple. You just need to put aside a certain amount each month, each pay period, put it into an index fund, make sure it's in something like an IRA or, you know, and I'm sure, Jim, your recommendation for people, young people now starting out, put it in a Roth IRA. And then not only does it compound tax-free, but you can take it out tax-free. This is just the best advice anybody could get, and you can do it with a simple index fund.
And by the way, that's an indirect, though I know you didn't mean it that way, plug for your book, because you show people how to do it. You are very thorough in your reasoning, but then also the practical applications. So what I guess I'm saying is you don't have to be a multimillionaire to buy your book and get enormous value. And I was not exaggerating when I said the introduction alone was worth thousands and thousands of dollars. So your premise, even before there was a broad-based index, was something like what you envisioned. A broad-based index was better than picking stocks. And you've given us a lot of backup here. So what is the major difference between your first edition 50 years ago and what you have written today, which I believe is going to be released January 3rd, 2023?
Well, in fact, the basic message has not changed. What has changed is what is available today for investors. As I mentioned, index funds didn't exist. Exchange traded funds did not exist. International funds did not exist. Money market funds where you could keep a cash reserve didn't exist. Roth IRAs didn't exist. 529 savings plans didn't exist. So the main differences are that the instruments that are available to actually do the strategy are entirely different, and they have in fact changed from period to period. There are also many new research findings that have been put in the book. Let me give you an example. There, as the book has changed, a new chapter on what is called behavioral finance has been included. Because sometimes in investing, we are our own worst enemies. What we tend to do is we get over optimistic when the market is going up, and we then put more money into the market, and investors do this regularly. The data are there, they're very clear. And then when times are tough, you know what people do? They take money out. This is exactly the time when they ought to be putting money in. As Warren Buffett has said, you buy when everyone is fearful. That's what you should be doing, but your emotions get a hold of you. And we are our own worst enemies. So avoiding mistakes, there's a whole chapter with all of the new information about behavioral finance. These are the kinds of things that have changed. And in fact, the actual instruments and the specific advice is entirely different from what it was 50 years ago. because the opportunities for investors, not only in investing, but in tax saving, are completely different from what they were 50 years ago.
We hope you enjoyed this video. And as a thank you for watching, we're giving you an exclusive opportunity to receive a free book. That's right. If you purchase a digital or hardcover copy of A Random Walk Down Wall Street 50th Anniversary Edition by Burton Malkiel, we'll send you a free digital copy of James Lange's forthcoming book, Retire Secure for Professors. It's a wonderful book for professors, university staff, or anyone who has significant funds in their IRAs and retirement plans. And it features a foreword written by none other than Burton Malkiel himself. Just purchase your copy of A Random Walk from Amazon.com, Barnes & Noble, IndieBound, or one of the other many booksellers where it's available for purchase. And then visit paytaxeslater.com/random walk and complete the form to receive your free digital copy of Retire Secure for Professors. And as an additional bonus, the first 100 people to purchase either the ebook or the hardcover edition of A Random Walk and complete our form will also receive a free hardcover edition of Retire Secure for Professors as soon as it's available in print.